Hi everyone, my name is Yang-jae Lee. I'm a lead portfolio manager of Global Growing Market Fund. The first important factor to consider when looking at the future emerging markets is what the impact of Trump 2.0 will be after the US presidential election. I would like to answer that question, the outlook for emerging markets in 2025, and the fund investment strategy today.
Hello, everyone. I'm Christopher Hartkopf. I work with Yang-jae, my lead portfolio manager on the GGM strategy. And I'm looking forward to answer questions on the Trump impact, the investment strategy, and the outlook for our investable universe. Markets are still trying to gauge the overall impact on what Trump's second term as president will mean, from potentially additional tariffs to increases in interest rates or a different rate outlook overall, and to possibly cuts in green subsidies. There are many unknowns on the horizon at the moment. The impact on emerging markets particularly will be felt throughout. We have seen some early signs of rotation out of interest rate sensitive countries, moves in the EV and renewable supply chains, as well as a building in expectations for the Chinese stimulus, depending on the final level of additional tariffs imposed. So we expect the trends of onshoring to continue and put upward pressure on inflation. As mentioned, this will impact the pace of rate cuts and also limit monetary flexibility in our investment universe. Looking back at his first term as president and the negotiations back then, we come away more positive than what current headlines really suggest. The eventually imposed tariffs were a lot more sanguine than the US's initial negotiation position had suggested last time around, and then what also was feared by the market, really. So our base case assumes something similar this time around. The Mexican peso has already depreciated around 20% against the US dollar in 2024. It depreciated to a similar magnitude in the last pre-Trump presidency year of 2016, but then followed a fairly stable path for the following 4 years. So we believe a similar scenario may unfold this time. The economy did just fine under the last Trump presidency, and the stock market was actually modestly up in US dollar terms for the first 3 years of his term. China will wait until the extent of the actual additional tariffs to be imposed are final before committing to any specific support package responses. We believe this balancing act will provide some downside protection to the Chinese economy as well as to the Chinese equity market. And it's not just about tariffs, though. It's also about increased tensions we've seen on technology-related export bans between the US and China. And China therefore leading to retaliation in other areas, such as rare earths exports to the US. So with the two linked themes we are most excited about for GGM countries really are, firstly, their role in the China Plus One strategy, and secondly, the narrow path of prosperity that some of these countries can tread by retaining good relations with both the China and the US by steering a more neutral geopolitical path. So it is worth noting, though, that we have seen significant increases in the trade deficit between the US and particularly some Southeast Asian countries, such as Vietnam, since 2018. So therefore, we also expect increased scrutiny from the US on these countries, as well as on China going forward. Very important to note, though, that compared to China, though, we believe these countries will continue to be a relative winner in a scenario of additional tariffs. GGM countries will continue to benefit from the diversification of supply chains away from China, and we have already seen that happening over the previous years and continue to expect this to happen.
Trump policies of increased tariff, tax cut, and deregulation are inflationary by nature, meaning US interest rate may stay higher and US dollar remain stronger than expected. This is generally not favorable for emerging markets economy, equity market, currency, and commodity prices. overall economic growth can be affected by lower demand, reduced trade volume, and delayed investment from higher price and cost. Lower demand and higher cost are negative for company earnings and equity market performance. Also, strong US dollar typically lead to emerging market currency depreciation and lower commodity prices. However, it is important to note that the impact of higher US rates and stronger US dollar will vary by country within the emerging markets. We believe that GGM countries, compared to other emerging market countries, will be more resilient in this environment. GGM fund only invests in countries where working population is growing. Therefore, the fund is not investing in Russia, China, Taiwan, and Korea, where working population is declining. This approach removes most of the geopolitical risk and some of the trade-related risk for our investment. Okay, as discussed so far, tariffs and strong US dollar has been the key headwind for emerging market equities, especially post-US election. However, despite increased risk and uncertainty, we believe emerging market equities, especially global growing market equities, may prove much more resilient than expected in 2025 for the following reasons. Number one, downside risk is well known and largely priced in. Number two, global growing market growth dynamics still remain relatively stronger than developed market, with key markets such as India, Brazil, UAE, South Africa, they're less vulnerable to trade tensions. Lastly, if US tariffs are predominantly targeted towards specific markets such as China, global growing market economies could benefit from rejigging of trade flows. We prefer markets with strong domestic narratives that are insulated from external risk, such as India, Brazil, UAE, South Africa, and ASEAN countries. Additionally, we seek opportunities in markets where external risk is already priced in, particularly those with attractive valuation and potential for positive change following the resolution of tariff uncertainty, such as Mexico and Vietnam.
Yeah, stocks to watch and that have been core holdings for the GGM fund are FPT in Vietnam, EMA Development in the UAE, and then a more recent addition to the portfolio has been Astra International in Indonesia. On FPT, FPT is a Vietnamese IT services company, capitalizing on the lower engineering costs in Vietnam and a deep pool of local talent. This really allows them to compete globally in a very fragmented IT services market, supporting their long-term growth ambitions. Their in-house talent development and strong presence in the Japanese market are key differentiators for the company. More recently, they also expanded into building AI factories using the full-stacked NVIDIA computing platform, which is seeing very good early growth momentum and provides another growth driver for FPT in the future. EMA Development is a UAE-based real estate development company benefiting directly from a cyclically strong real estate market in Dubai, but also from structurally higher expected population growth in the Emirates. Dubai particularly has seen an acceleration in population growth over the last 2 years, also driven by increasingly more expats moving there. The company continues to see strong momentum with sufficient land bank to support growth in the near future, while limited evidence of speculative activity is actually present. Then Astra International, as I said, a more recent addition to the portfolio, is an Indonesian conglomerate which is mainly exposed to the domestic consumer. Their businesses span from 2- and 4-wheeler distribution, consumer financing, healthcare, to domestic mining operations. And we like the stock really as its valuation has been overly punished due to excessive fears of competition in the 4-wheeler market, as well as our way to express our positive view on the Indonesian mass market consumer. Thank you.
Thank you.